Hello, this is Mark Sorrell with PlanVision. This video is going to review different asset allocation models and how they would be impacted during a period of significant market sell-off and period of market panic. We'll look at 4 Vanguard Life Strategy portfolios. These are very popular. These are the Vanguard Growth, Moderate, Conservative, and Income portfolios. The first one we're going to look at is the Growth portfolio, and this one is 80% stocks and 20% bonds. And so I want to see how the fund performed in the worst one-year period in the last 25 years. And it's from March 2008 through February of 2009. It was down 40%. So that's a loss. That's an example of how severe a loss could be. In 3 months alone, it was down 28%. So that's a mix that is 80% stocks and 20% bonds. The next portfolio is the moderate portfolio, and this is 60% stocks and 40% bonds. And during the same period of time, this portfolio was down 32%, so not quite as much. The next portfolio is the Vanguard Conservative Growth portfolio, and this one is 60% bonds and 20% stocks. And during the same period of time, March 2008 through February 2009, this one was down 24%. The final portfolio is the Vanguard Income Life Strategy Income portfolio, which is 80% bonds and 20% stocks, much more conservative than the rest. And this portfolio in 2008 and 2009 was only down 14%. So a distinctly different mix and more conservative and safer model. So let's consider some numbers and how you might be impacted. For example, if you had a $1,200,000 portfolio at the worst of the loss, at least for the one-year period, this amount of money would have dropped down to $720,000, a 32% loss, $816,000. 24% loss down to $912,000, and then a 14% loss was only down to $1,032,000. So if you are in retirement, close to retirement, or simply evaluating your portfolio and the amount of risk that you're comfortable with, think about how much loss you could really endure. And something that I would also encourage you to think about, it's not just the fact that your money's going down and you're seeing the value of the money that you're going to live off of go down. It's what's going on at the time. How bad is the news? Can you handle the onslaught of information on a daily basis about how grim things are? What company might fail that we're not aware, that nobody ever thought was going to fail? Is there a country that's in the Western world that is struggling to pay back its debts? That type of news can certainly scare a lot of investors. And you might begin to think, how far is this really going to go? Is my $720,000 portfolio going to go down to $600,000? Is it going to be cut in half? Could it go down to $500,000? So give this strong consideration as you think about how aggressive you want to be. And I think for many of my clients and many people entering retirement or close to retirement, I think it's better to err on the cautious side and preserve assets instead of trying to strive for growth, particularly as you transition into retirement years. So there you go. Let me know if you have any questions at all or need some help or recommendations on your asset mix.